Hello friends, this is Victor here. Welcome back to the Buy the Dip Intelligent Investor channel. In this video, I'm going to analyze Taiwan Semiconductor Manufacturing stock or TSMC. I will explain why I believe TSMC is the best AI semiconductor stock after Nvidia. Specifically, I will talk about why TSMC stock is likely undervalued now because of the recent large sell-off caused by China's DeepSeek. After DeepSeek released its latest AI model and claimed that its training cost was much lower, the market became very concerned that AI spending may slow down going forward. Of course, if AI spending slows down a lot, it will impact all the major AI semiconductor companies. This is why Nvidia, Broadcom, AMD, and even TSMC have dropped quite a lot recently. Here's another side of the story. OpenAI probed into DeepSeek's latest AI models. OpenAI found evidence showing that DeepSeek has been training its AI models using ChatGPT using a training process called knowledge distillation. Of course, if this is true, the cost of training DeepSeek's AI models would be much lower. Throughout this video, I will explain whether AI spending will slow down and how cost-efficient AI models will affect TSMC over the next several years. Other than talking about DeepSeek and how it will impact the semiconductor market, I will discuss TSMC's competition with Intel Foundry. You will learn about TSMC's biggest competitive advantage over Intel Foundry and why TSMC will continue dominating the semiconductor foundry market for many years. So in this video, I will explain why I believe TSMC is the best AI semiconductor stock after Nvidia. Specifically, I will talk about why TSMC stock is likely undervalued after the recent market sell-off caused by China's DeepSeek. You will learn about these topics in this video. First, I will explain whether DeepSeek and other cost-efficient AI models will lead to lower AI CAPEX. Then I will talk about TSMC's biggest risk to consider, TSMC's long-term growth prospects in AI and HPC applications, TSMC stock valuation, and whether I will buy more TSMC stock going forward. If you like this video, make sure to hit the like button, subscribe, and turn on the notification button. I will continue to make many excellent investing videos every week that will help you become a great investor. Each video usually takes me more than 30 hours to make, so if you like this channel and want to support it, check out my Patreon blog in the video description. Our goal is to help all our members become multi-millionaires through investing. Once you become a premium member, you can follow all the stocks I'm investing for the long term, follow my personal stock portfolios, and download the latest intrinsic valuation models for all the stocks I'm analyzing, so you will know when a company becomes undervalued, fairly valued, or overvalued now. Also, you will have access to all my latest stock ratings for all the stocks I'm analyzing. The link is in the video description. Take a look, let's start. Let's talk about the biggest risk right now, which is impacting almost all the major AI semiconductor companies. As I mentioned earlier, right before I started making this video, a quant hedge fund from China released an open source LLM called DeepSeek. DeepSeek is a huge breakthrough because DeepSeek is almost as competitive as the top AI models from OpenAI, Google, Meta, and Anthropic, at least in benchmarks. More importantly, according to DeepSeek, the Chinese AI research company had a very limited budget and had much fewer Nvidia AI GPUs to train its AI models. According to the Financial Times, DeepSeek claimed that it used around 2,000 Nvidia H800 AI GPUs and spent only $5.6 million to train its V3 AI model with 671 billion parameters. This is a fraction of what OpenAI, Google, and Meta have spent to build their frontier AI models. In comparison, OpenAI, Meta, and Google have spent hundreds of millions to train their large language models or LLMs. Moreover, US companies have access to Nvidia's most powerful AI GPUs, such as the H100 and H200. In comparison, China has very limited access to Nvidia's most powerful AI GPUs. Of course, the market is very concerned because if DeepSeek's claim is correct, it shows that big techs have been overspending on AI infrastructure and AI data centers, specifically Nvidia's AI GPUs and AI supercomputers. If DeepSeek's claim is correct, companies will only need to invest several $1 million instead of billions of dollars to build their frontier AI models that could compete with OpenAI, Google, and Meta. This implies that future AI models may need much less AI compute and far less AI capex than expected. Of course, if this is true, it will greatly impact all the major AI semiconductor companies including Nvidia, TSMC, Broadcom, and AMD. This is why DeepSeek has caused a huge market sell-off recently. Here's the deal, the story about DeepSeek requiring much less AI compute is overblown. I believe DeepSeek misrepresented its claims. Here's why. First, according to several sources, OpenAI has found evidence that DeepSeek has been using ChatGPT's output to train its own open-source AI models using a teacher-student training method called knowledge distillation. Of course, if this is true, DeepSeek could copy OpenAI's R1 reasoning model with much less AI compute at a much lower cost. This is likely why DeepSeek only spent around $5.6 million to train its model. Second, DeepSeek claimed that it used around 2,000 Nvidia H800 AI GPUs to train its V3 model, which could compete with the top AI models from OpenAI, Meta, and Google. I don't think this is true at all because DeepSeek is known to have one of the most AI compute in China. According to Scale AI CEO Alexander Wang, DeepSeek has around 50,000 Nvidia H100 GPUs to train AI models. Based on what using only 2,000 H800 AI GPUs is not enough to build a frontier AI model that can compete with OpenAI's frontier AI models. Of course, DeepSeek cannot admit that they have thousands of Nvidia's H100 GPUs because Nvidia's top-end AI GPUs are sanctioned. China is not supposed to have Nvidia's most powerful AI GPUs. Third, let's say DeepSeek's claim about its much lower training cost is correct. DeepSeek did not disclose how much money is spent to research its latest AI models, how much money is spent to acquire its training data and to curate the data before training its latest models, how much money is being spent on AI inferencing, and of course, how many Nvidia AI GPUs the company actually owns to train other AI models. Training AI models is only one of the steps. Based on what I know, AI inferencing can become very expensive when there are thousands or even millions of users using the AI app at the same time. For example, DeepSeek will need to buy a lot more AI GPUs from Nvidia for AI inferencing workloads because the company cannot handle too many users all at once without having a large cluster of AI GPUs and servers. Here's the important part you should know. This is very important for Nvidia, TSMC, and other leading semiconductor companies. Contrary to what the market believes, AI capex will not slow down at all because the lower cost of computing and more cost-efficient AI models will lead to much higher AI consumption and higher AI demand going forward. This is what we call the Jevons paradox. Jevons paradox is an economic concept that describes how technological improvements that increase the efficiency of resource use can lead to an overall increase in resource consumption. In this case, much higher AI consumption and higher AI demand, rather than a decrease. Let's consider this. When the cost of developing AI models and the cost of computing go down significantly, the AI market becomes much larger because AI will become much more accessible to everyone. When AI models become much cheaper and easier to develop, AI demand and AI consumption for both consumers and large enterprises will increase a lot. AI developers and AI companies will continue developing better and more cost-efficient AI models and applications. This will lead to higher returns on AI investments, which will lead to higher AI capex over the long run. This is my prediction. I believe this AI investment cycle will continue to grow for many years because AIs will become much better, more cost-efficient, and much more useful over time. I believe this secular trend will benefit Nvidia, TSMC, Broadcom, and other major semiconductor companies the most over the long run. Let's go back to TSMC. What are the biggest risks we should consider? TSMC is always impacted by geopolitical tensions between the US and China, and between China and Taiwan. For example, the US restricts TSMC from making advanced semiconductor chips for China and other customers that are blacklisted. Each time the US restricts TSMC from selling certain chips to China, the news media tends to exaggerate the story. Here's the biggest risk to consider. Many investors and news media have speculated that China may invade Taiwan. Of course, if this happens, it will impact TSMC the most because TSMC's most important semiconductor fabrication plants or fabs are all in Taiwan. Here's the deal. Claims about China invading Taiwan are pure speculation, spread by many news media and investors. They are simply fear, uncertainty, and doubt, or FUD, or what I call fake news. China will not invade Taiwan because of these major reasons. First, the US and China are in an AI arms race that will last for many years. They are in a chip war that will last for many years. The US and China are competing to become the dominant leader in AI, advanced chip manufacturing, advanced chip designs, cloud computing, robotics, and the most advanced tech. Both countries understand that which country has the most advanced AIs and the best chip manufacturing capabilities will likely dominate the global market, the global economy, trade wars, and any future conflicts. As you may already know, the US has been restricting China from buying the most advanced AI chips from Nvidia, AMD, and Intel. For example, the US and its partners such as the Netherlands and Japan have been restricting China from buying the most advanced chipmaking tools such as the EUV and DUV lithography systems from ASML. Recently, after China released DeepSeek, the US has been concerned that China's AI capabilities are catching up with the US. Let's consider this. Becoming the dominant leader in AI and advanced chip manufacturing is the US most important priority right now because of national security reasons. TSMC has the most advanced chip manufacturing capabilities and technologies in the world, so it will not make sense for the US to allow China to invade Taiwan to take control of TSMC. Second, if anything happens to TSMC, it will cause a global supply chain crisis that will impact everyone, not just TSMC. It will cause a huge economic crisis and much higher inflation around the world, especially for products that need semiconductor chips from Taiwan. It will be everyone's problem because all the major tech companies around the world rely on TSMC to manufacture their leading-edge chips. For example, Apple, Nvidia, Broadcom, Qualcomm, MediaTek, Amazon, Google, Meta, Microsoft, Tesla, and even Intel need TSMC to manufacture their leading-edge chips. Here's the important part you should know. TSMC manufactures over 60% of the logic chips around the world. Specifically, TSMC manufactures more than 90% of the most advanced chips in the world, including Apple's SoCs in iPhones and Nvidia's AI GPUs that are used by OpenAI, DeepSeek, Google, Meta, and other AI companies. Broadcom's custom ASIC chips, Qualcomm's SoCs, AMD's CPUs and APUs, and even some of Intel's CPUs. Based on what I know, it's nearly impossible to replace TSMC because TSMC has the most advanced process node technologies, the best ecosystem in the foundry market, the largest economies of scale, a huge cost advantage over competitors, the largest chip manufacturing capacity, and the most customers supporting TSMC's ecosystem. Samsung Foundry is TSMC's closest competitor, but Samsung Foundry is far behind TSMC in both process node technologies and chip manufacturing capacity. Intel Foundry is another major competitor, but like Samsung Foundry, Intel is far behind TSMC in process node technologies, economies of scale, and mass manufacturing of chips. The most advanced semiconductor fabs can cost between $10 billion and $20 billion each. It takes at least several years to build out each fab. You will need the expertise, the right talents, and many supply chain partners to help build each fab. This is why there are only 3 leading-edge semiconductor foundries in the world: TSMC, Samsung Foundry, and Intel Foundry. Since all the major US tech companies rely on TSMC to manufacture their leading-edge chips, the US will not allow China to disrupt TSMC in Taiwan. Now, to reduce geopolitical risk, TSMC is building more fabs around the world, specifically in the US, Japan, and Europe. In the US, TSMC will have 3 advanced fabs in Arizona. At the time of making this video, TSMC's first fab in Arizona is already online. According to management, the first fab has already entered high volume production, producing chips for Apple and AMD using the N4 process node. More importantly, the first fab's yield is already comparable to the fabs in Taiwan. Over the next several years, TSMC's second and third fabs will eventually go online and start producing other leading-edge chips using TSMC's N3, N2, and A16 nodes. The biggest downside is that building fabs in Arizona is very expensive. These US fabs are much more expensive than the fabs in Taiwan because they have not achieved large economies of scale yet and because of higher prices in the supply chain. Here's the important thing you should know. Even if TSMC's US fabs are more expensive, TSMC's largest customers, such as Apple, Nvidia, and AMD, are still willing to pay extra to buy chips from TSMC's US fabs. This shows that TSMC is mission critical for all US tech companies. In terms of competition, TSMC's biggest competitors is Intel, specifically Intel Foundry. However, as you may already know, Intel has run into many issues in recent years. For example, about a month ago, Intel's board of directors fired Pat Gelsinger, who was supposed to turn the company around. Now, Intel is trying to regain its chip leadership again by achieving 5 process nodes in 4 years, by introducing the 18A node in 2025, followed by the 14A node. But here's the important part you should know. Many investors do not know this. Intel has been misleading investors for many years. For example, Intel has been telling investors that the company is on track to achieving 5 process nodes in 4 years. This is not true at all. Here's why. First, Intel has already cancelled the 28 node. Instead, Intel is planning to catch up to TSMC by mass producing its 18 node by the second half of 2025. Second, Intel's process roadmap is very misleading. This roadmap tells investors when Intel is planning to introduce each new process node. This roadmap is not a high-volume production roadmap. Realistically, it should take Intel at least 1 year for these new nodes to enter high-volume production. These new process nodes will need to have very good yields. Otherwise, if they have poor yields, they will be too expensive for customers to buy. In comparison, TSMC's process roadmap is much more reliable. TSMC's process roadmap shows when each process node will enter high-volume production. This is much more accurate than Intel's roadmap. Let's consider this. In the upcoming years, even if Intel can catch up to TSMC's process nodes, most customers will still choose TSMC to manufacture their chips because TSMC's ecosystem and process node technologies are much more mature and reliable than Intel's. TSMC has a much better track record of mass producing leading-edge chips on time and with much better yields than Intel. In comparison, it's very risky for large customers such as Apple, Nvidia, and AMD to outsource chip manufacturing to Intel because Intel has had too many execution issues, yield issues, chip manufacturing issues, and major product delays over the years. At the time of making this video, Intel is having financial problems. Based on my understanding, Intel does not have enough capital to support both its chip design business and its foundry business. Building a foundry business is extremely capital intensive. This is why Intel is looking into splitting its foundry business from its chip design business. If you're Apple, Nvidia, or AMD, why will you take the risk of investing in Intel's foundry when you know Intel has financial problems? Also, Intel competes with Apple, Nvidia, AMD, Broadcom, and many other major tech companies, so it will not make sense for these major tech companies to outsource chip manufacturing to Intel and give Intel their proprietary chip designs and IPs. In comparison, TSMC is a pure-play semiconductor foundry. TSMC does not compete with its customers. This is why most customers will still outsource chip manufacturing to TSMC over Intel, even if Intel can catch up to TSMC's process node technologies. Let's take a look at TSMC's financials. I believe TSMC has a strong balance sheet. According to the most recent financial report, TSMC had 74 billion in cash equivalents. In comparison, TSMC had 30 billion in short-term and long-term debt. This means TSMC can pay off all its debts in advance and still have $44 billion in cash. Over the past 10 years, TSMC has had very consistent revenue growth, operating income growth, high operating margins above 40% in most years, and increasing free cash flows over time. I mentioned this earlier, the barriers to entry in the foundry market are extremely high. because building fabs is very expensive. Building a leading-edge fab can easily cost between 10 billion and 20 billion each. This is why there are only 3 major leading-edge foundries in the world: TSMC, Samsung Foundry, and Intel Foundry. TSMC has had the highest gross margin and the highest operating margin compared to competitors for many years because of TSMC's leading-edge node technologies, large economies of scale, much higher cost advantage compared to competitors, and the largest ecosystem that is supported by thousands of customers. It is nearly impossible to copy TSMC's process node technologies, large economies of scale, and cost advantage. Let's talk about TSMC's long-term growth prospects. I believe TSMC is the best AI semiconductor company after Nvidia. There are several reasons. First of all, as I mentioned earlier, TSMC manufactures more than 90% of the leading-edge chips in the world. All the major tech companies including Nvidia, Broadcom, Qualcomm, AMD, MediaTek, Apple, Google, Meta, Microsoft, and Amazon rely on TSMC to manufacture their leading-edge chips. Almost all of them are making their own AI accelerators and AI chips because they want to stay competitive in their industries. Right now, we're still at the beginning of the AI revolution. AI models are getting larger and much more sophisticated. More importantly, as shown by DeepSeek, AI models will become much more cost efficient and cheaper to use going forward. This means AI usage and AI consumption from consumers and large enterprises will increase much more. This will require a lot more AI inferencing chips and AI data centers. Of course, this secular AI trend will benefit TSMC the most because all the major companies need TSMC to manufacture their leading-edge AI chips, AI accelerators and networking chips for data centers, AI SoCs for smartphones, or AI GPUs for consumers. This is why TSMC will likely have high double-digit revenue growth rates over the next 3 years. More on this later. To understand TSMC's long-term prospects, we have to look at TSMC's process node technologies. At the time of making this video, TSMC's N5 and N3 nodes are the leading-edge nodes. These leading-edge nodes will generate the most revenue for TSMC because all the major tech companies need TSMC to make their most advanced chips. All the major companies want to improve their chips' performance and power efficiency while making their chips much smaller. This is known as PPA, or power, performance, and area of the chip. This means the demand for TSMC's advanced nodes will increase much more over time. TSMC has a lot of pricing power. TSMC can increase its pricing every time the company introduces new nodes and better processes that will help customers improve their chips' power, performance, and area, or PPA. Most customers want to outsource chip manufacturing to TSMC first. If TSMC does not have the capacity, then they may outsource chip manufacturing to Samsung Foundry, Intel Foundry, or other much smaller foundries. Here's the important thing you should know. TSMC will continue introducing new process nodes that will improve chips' performance, power, and area, or PPA. For example, TSMC will start mass producing its N2 node in the second half of 2025. Then TSMC will start mass producing its A16 node in the second half of 2026. All these new process nodes will generate much higher revenues for TSMC over time. TSMC has these 5 major platforms: high performance computing or HPC, smartphone, Internet of Things or IoT, automotive, and digital consumer electronics or DCE. Smartphone and HPC platforms are the biggest revenue contributors for TSMC. Over the next several years, high-performance computing or HPC will drive the largest growth for TSMC because of the great demand for AI chips and AI systems that are needed to train and infer AI models and AI applications. Once autonomous vehicles and AI robotics become the norm, they will need a lot more semiconductor chips that use the best process nodes from TSMC. Moreover, as I mentioned earlier, all the major tech companies will continue releasing chips that are more performant, smaller, and more energy efficient. Here is the biggest secular trend that will benefit TSMC the most over the next 5 to 10 years. AI CAPEX or AI investments will continue to increase over the next several years, even if AI models become much more cost efficient going forward. As I mentioned earlier, the lower cost of computing and the lower cost of building AI models will increase AI demand and AI consumption from consumers and large enterprises. Of course, this will lead to more AI developments, higher AI CAPEX, and higher returns on AI investments. This AI investment cycle will continue for many years as AI progresses to AGI and as the demand for AI continues to increase over time. Let me give you several examples to show that AI CAPEX will increase much more over the next several years. Microsoft is planning to spend about $80 billion on AI data centers this year. Similarly, Meta is planning to invest around $60 billion to $65 billion in capital expenditures this year. Most of this CAPEX will be spent on AI infrastructure. Recently, Donald Trump announced the Stargate project that will cost up to $500 billion over the next 4 years. This AI infrastructure project will be run by OpenAI, Oracle, and SoftBank. Based on what I know, this huge AI infrastructure project will be built to support OpenAI's AI workloads. During a recent earnings call, Broadcom revealed that its 3 largest ASIC customers, Google, Meta, and a third customer, are all building AI data centers that will have 1 million plus GPUs each. For example, Meta is building a 2 gigawatt AI data center. Meta's AI data center will have 1.3 million AI GPUs by the end of 2025. So all these AI data center investments will benefit TSMC the most. Let me show you this long-term guidance from TSMC. I believe this guidance suggests that TSMC will likely have strong revenue growth this year and over the next 5 years. TSMC's management believes that TSMC can maintain a long-term gross margin of 53% or higher, even if the US fabs would dilute the company's gross margin by around 2% to 3% each year. CAPEX is expected to be between $38 billion and $42 billion this year, compared to $29.8 billion last year. TSMC's revenue is expected to increase by around mid-20% this year because of the growth catalyst I talked about earlier. TSMC expects its revenue from AI accelerators to double in 2025 and grow at a mid-40% CAGR over the next 5 years. This suggests that Nvidia will likely have high revenue growth rates over the next 5 years. Over the next 5 years, starting from 2024, TSMC expects its revenue to grow at a 20% CAGR. This is much higher than TSMC's previous guidance.
Longer term, excluding the impact of foreign exchange rate and considering our global manufacturing footprint expansion plans, we continue to forecast a long-term gross margin of 53% and higher is achievable. Next, let me talk about our 2025 capital budget and depreciation. Every year, our CAPEX is spent in anticipation of the growth that will follow in the future years, and our CAPEX and capacity planning is based on the long-term market demand profile. At TSMC, a higher level of capital expenditures is always correlated with higher growth opportunities in the following years. In 2024, we spent $29.8 billion as we continue to invest to support our customers' growth. With our strong technology leadership and differentiation, we are well positioned to capture the multi-year structural demand from the industry megatrends of 5G, AI, and HPC. In 2025, we expect our capital budget to be between $38 and $42 billion as we invest to capture the future growth. Out of the $38 to $42 billion CAPEX for 2025, about 70% of the capital budget will be allocated for advanced process technologies. About 10 to 20% will be spent for specialty technologies, and about 10 to 20% will be spent for advanced packaging, testing, mask making, and others.
Entering 2025, we expect fabless semiconductor inventory to have returned to a healthier level exceeding 2024. We forecast the Foundry 2.0 industry to grow 10% year over year in 2025, supported by robust AI-related demand and a mild recovery in other end market segment. Supported by our technology leadership and broad customer base, we are confident we can continue to outperform the industry growth. We expect 2025 to be another strong growth year for TSMC and forecast our full-year revenue to increase by close to mid-20% in US dollar terms. Now I will talk about AI demand and TSMC's long-term growth outlook. We observe robust AI-related demand from our customers throughout 2024. Revenue from AI accelerators, which we now define as an AI GPU, AI ASICs, and HBM controller for AI training and inference in the data center, accounted for close to mid-teens% of our total revenue in 2024. Even after more than tripling in 2024, we forecast our revenue from AI accelerator to double in 2025 as the strong surge in AI-related demand continues. As a key enabler of AI applications, the value of our technology platform is increasing as customers rely on TSMC to provide the most advanced process and packaging technologies at scale in the most efficient and cost-effective way. To address the structural increase in the long-term market demand profile, TSMC is working closely with our customer to plan our capacity and investing in leading-edge specialty and advanced packaging technologies to support their growth. Underpinned by our technology leadership and broad customer base, we now forecast the revenue growth from AI accelerators to approach a mid-40% CAGR for the 5-year period, starting off the already higher base of 2024. We expect AI accelerators to be the strongest driver of our HPC platform growth and the largest contributor in terms of our overall incremental revenue growth in the next several years. For the 5-year period starting from 2024, we expect our long-term revenue growth to approach a 20% CAGR in US dollar terms, fueled by all 4 of our growth platforms, which are smartphone, HPC, IoT, and automotive. Finally, I will talk about the N2 and the A16 introduction. Our 2nm and A16 technologies lead the industry in addressing the insatiable need for energy-efficient computing, and almost all the innovators are working with TSMC. We expect a number of the new tape-out for 2nm technology in the first 2 years to be higher than both 3nm and 5nm in their first 2 years, fueled by both smartphone and HPC applications. N2 will deliver full node performance and power benefit with 10 to 15 speed improvement at the same power, or 20 to 30% power improvement at the same speed, and more than 15% chip density increase as compared with the N3E. N2 is well on track for volume production in second half of 2025 as scheduled, with a ramp profile similar to N3. With our strategy of continuous enhancement, we also introduced N2P as an extension of N2 family. N2P features further performance and power benefit on top of N2. N2P will support both smartphone and HPC applications, and volume production is scheduled for second half 2026. We will also introduce A16 featuring Super Power Rail, or SPR, as separate offering. TSMC's SPR is an innovative best-in-class backside power delivery solution that is first in the industry to incorporate a novel backside metal scheme that preserves the gate density and device with flexibility to maximize the product benefit. Compared with the N2P, A16 provides a further 8 to 10% speed improvement at the same power, or 15 to 20% power improvement at the same speed, and additional 7 to 10% chip density gain. A16 is the best suitable for specific HPC product with a complex signal route and dense power delivery network. Volume production is scheduled for second half 2026.
Let me show you this consensus forecast from Skin Alpha. TSMC's revenue is expected to grow by around 28% this year. This is slightly higher than management's guidance. Over the next 2 years, TSMC's revenue is expected to grow by around 18% to 19% each year. In terms of EPS forecast, TSMC's EPS is expected to grow by around 28% this year. Then over the next 2 years, TSMC's EPS growth is expected to decelerate. Let's take a look at TSMC's valuation. At the time of making this video, I believe TSMC is greatly undervalued. For example, TSMC's forward PE is expected to be around 22 this year. This is exceptionally low for a semiconductor company that is expected to grow by around 28% this year. Next year, TSMC's forward PE is expected to be just right under 20. I always say this, if TSMC is a US-based semiconductor foundry company, TSMC's PEs would be much higher. Let me show you this investing app I'm developing with a friend. This is a preview. Our investing app will be out this year. The orange line represents TSMC's fair value over time. The blue line is TSMC's share price. At the time of making this video, TSMC's share price is well below its fair value line, mainly because of the recent large sell-off caused by DeepSeek. Based on our investing app here, I believe TSMC's fair value should be around $220 per share. This suggests that TSMC is likely undervalued. I also calculated TSMC's intrinsic value myself using this intrinsic valuation model. If you want this intrinsic valuation model, you can download it from my Patreon blog. The link is in the video description. Based on my intrinsic value estimate here, I believe TSMC's current intrinsic value should be around $230 per share. Just to compare, Morningstar has given TSMC a much higher fair value of $273 per share. Based on all these valuation models I just showed you, I believe TSMC stock is greatly undervalued. So will I buy TSMC stock? My answer is yes. I will continue buying more TSMC shares over time because I believe TSMC is the best AI semiconductor company after Nvidia. Typically, I like to keep investing in the best company only when it's undervalued below its intrinsic value. For example, I already have TSMC stock in this account. I also have TSMC in other accounts. I bought TSMC when it was much more undervalued before. Now it's already a multi-bagger stock. I expect TSMC will grow much more over time because of the long-term growth catalysts I talked about in this video. To summarize, I believe TSMC will benefit the most from the current AI revolution and the large AI investments over the next several years. All the major tech companies such as Apple, Nvidia, AMD, Broadcom, Qualcomm, and Google rely on TSMC to manufacture their leading-edge chips. AI models will become more cost-efficient and much cheaper to use going forward. This will lead to higher AI consumption and higher AI demand, which will lead to higher AI CAPEX and higher returns on AI investments over time. Of course, when companies are earning higher returns on their AI investments, they will develop more advanced AI models and AI apps that will require even more AI chips for inferencing and training. So the AI investment cycle will continue to go for many years. Even without AI, all the major tech companies will need to use TSMC's most advanced process nodes to make their chips smaller, more powerful, and more energy efficient. Now, all these are only my opinions and my analysis that's based on my research. They are not financial advice. There are always risks associated with investing. It's very important to invest in what you know and not speculate. You will need to do your own research and do your extra due diligence first before investing in anything. Thank you for watching this video and supporting our channel. This is Victor from the Intelligent Investor channel, and I will see you in the next video.